Welcome to the Strategy Skills podcast. I'm your host, Chris Safarova, and this show is brought to you by our firm, Firms Consulting, the team behind strategytraining.com. And today we have a very special guest, Sarah Keohane Williamson. Such a beautiful name, Sarah. Welcome. And just a few words. Sarah is the CEO of FCLT Global, which is a non-profit research organization whose mission is to focus capital on the long term to support a sustainable and prosperous economy. Sarah was a senior engagement manager at McKinsey & Company, worked at the U.S. Department of State, was mergers and acquisitions investment banker for Goldman Sachs, earned her MBA with distinction from Harvard Business Review, and also an author of the upcoming book, The CEO's Guide to the Investment Galaxy, on how executives can navigate today's markets to build great companies. Sarah, so great to have you with us.
Chris, thank you so much for having me today. I really appreciate it.
So you graduated from Harvard with distinction. I also graduated with distinction, so I have a sense of what it takes. But beyond the academics, what was the most important idea or experience you walked away with? And maybe you could share with us one related to something you learned about business and then one related to something you learned for you personally.
So I guess I would say that I grew up in a family of academics. Nobody in my family has been in business. And so I went to college. I studied economics. And then I went to Wall Street. As you mentioned, I was a mergers and acquisition analyst at Goldman Sachs. At the time, it was actually quite a small firm, believe it or not. And it was the 80s on Wall Street. So you probably know what that means. And it was a tough place, but I learned a huge amount because I worked with people who were very driven, had very high expectations, pushed me hard. And so I think that having that early days there in New York and then moved to London, where it was a very, very new and small place at the time, where the lessons I learned there were to sort of roll with the punches, frankly. And there were some There were some punches. There were markets that went up and down. There were challenging deals, issues, people, but it gave me a really good sense of sort of how that world works. And so that and it also, as particularly as a young woman at the time, gave me a good sense of how to sort of survive in that in that little bit rough and tumble world. So I learned that there, and I took that with me to Harvard Business School. But then I also, as you mentioned before, business school, worked for the State Department, which was the U.S. State Department, which was really, of course, about diplomacy, about global, about getting along with others, about trying to understand other people's perspectives. And so I think that the combination of those two things taught me a lot. And then I went to business school and learned a lot more about business there.
When you started your career, how did you saw your path unfolding, and what were some of the key defining moments that nudged you in slightly different direction, or maybe not slightly?
Mm-hmm. Well, so as I didn't know much about business when I went into it, but I grew up in a small town and grew up without having, a lot of ability to travel around the world. Didn't have much money at the time, and so I will always remember this vision I had when I was, I don't know, maybe 11 or 12 years old, riding along on a bicycle and realizing that I wanted to be an international banker. And I didn't know really what that was, but I knew international meant travel, which I wanted to do, get out of the small town I was in. I figured that banks had money, which I didn't have any of, so I thought that would be a good thing. And so somehow I had this idea that I wanted to be an international banker. Now, I'm not an international banker, but my career was not that different than that. So I did investment banking globally, State Department, as I mentioned, McKinsey, and then I spent most of my career at Wellington Management, which is a large institutional investment management firm, spending my time around the world. And so that early nudge of an idea that markets were interesting, that global was interesting, is something that I carry with me today into focusing FCLT Global, which is about focusing capital on the long term globally. So those were, it was the germ of idea that really wasn't very practical, that sort of developed into something a bit more practical over the years. But if you'd ask me, a number of years ago what I would be doing today, wouldn't have had, I wouldn't tell you that, I wouldn't give you the right answer. Let's put it that way.
And most driven, very successful people would not be able to, because as they continue with their career, also what they see they can do and how they can contribute expands, because they expand themselves as professionals and individuals. So I want to spend a little bit of time on each area of your career, milestone, so to say. So when you were at Harvard, did you feel that you belong? Or conversely, maybe you realized you absolutely did not? And how did that shape the way you lead today?
Mm-hmm. So when I was at Harvard Business School, there were not that many women. It was maybe 20%, maybe 25% women. So there were women. There weren't a few, but we were still pretty much in the earlier stages of having a significant presence there. Now, I had come from Wall Street, where there were virtually no women. When I joined Goldman Sachs, there were no women partners, for example. And so that part of it, I suppose, should have made me feel like I didn't belong, but actually felt sort of typical to me. I think that I felt like I belonged because Harvard Business School was a place where everybody had to talk and everybody had to listen to each other. But I learned an awful lot from my classmates who maybe had run a factory or had been, in a family business or had come from a different country. So I think the reason I felt like I belonged because it was a place that even at that time was seeking different points of view, and that part of the whole method of learning is to hear the perspective of somebody who's maybe had a very different background. For example, we had a couple of military guys in my section. Their style of leadership, their experiences were really different from mine. But I still remember some of the things they said all those years ago.
Are there specific things, maybe one or two, that you feel comfortable sharing?
I think, just to pick on one of them, there was a lot of analyze things and, think about all these angles. And I remember one guy said, if you want to know what's going on, open the door, walk out and talk to the people. And I'm like, yeah, actually, that's what you need to do. So I think that there was a bit of that, sometimes theoretical versus super practical, that to me has sort of defined what I've tried to do, which is to be research driven, academic in many ways, but always super practical, not ivory towerish in any way.
And I think that phrase is something many of our listeners needed to hear right now, because things are changing so fast. And for leaders, sometimes it's confusing what's happening, and they spending a lot of time analyzing data, but they also need to walk out the door and talk to people. Mm-hmm. Yeah. So that is one of the ways that you probably changed a little bit as a leader. Do you feel that there were other ways that you changed as a leader if you compare yourself the way you entered Harvard Business School and how you were when you left?
So I would say that throughout a career, the transition people go through is from answering questions to asking questions. So if early in your career, the question is always, well, what's the right answer? What's the number? What's the what's the analysis say? And you have to be able to answer the question. What is that? Where does the data lead you? What does this tell you? But then as you go through a career, essentially what happens is you start formulating the question and thinking about what is the most important question. And then as you go further in your career and you have teams who are doing the work, doing the real work and answering those questions, it's how do you make sure you're actually working on the issue that matters. And the question that matters changes over time. So at least for me, early on it was, is this deal going to happen? Why is it going to happen? Is it going to happen? And then at McKinsey, it was much more about what's the strategy? Does this make sense? Will this work? Will it not work? At Wellington, it was much more about, where our market's going, what's happening in the world. And what I'm doing now is sort of why does it all matter? And how can we make it matter, and make more impact on savers and communities over time. So the question changes as you go through, and the probably percent of time that you're answering versus asking changes, I think, as you go through a career.
And the last question on Harvard. How do you feel it prepared you and did not prepare you for the leadership challenges you had to face later on?
Yeah. So I think the way that it did prepare me is that it built me a network of people that I can ask questions to. So today, when I don't know what I'm doing, I often think, who do I know that knows something about this? Let me give them a call. I'll just give you a simple example. We're launching this book that we'll talk about in a minute. And I've never written a book before. I've never launched a book before. But one of my classmates had and knows people who have done that. And so I called him up and said, how does this work? Like, what do you do? And I got a sort of an expert lesson on, well, you could talk to so-and-so and so-and-so. So that I think really prepared me well for. I think it prepares people about how to think and ask questions and solve problems. I think what it doesn't always prepare people for is it can't prepare people for the events that will happen over in markets or lives or whatever it might be. And so those who have a false sense that they're prepared for everything and they know how to handle what will come, sometimes get a rude awakening because they don't know what's going to come, right? They don't know what's going to come next.
Goldman Sachs. Maybe you could share with us one or two key lessons from that period of your life.
Yeah. So first of all, I was very young. I went to Wall Street when I was 20 years old for various reasons. I graduated from college when I was 20. So just envision a 20-year-old young woman who on Wall Street in the 80s who doesn't really know anything. So that's kind of where I started. And I think so the biggest lesson that I sort of learned was I could walk into a room where I sort of frankly didn't have any right to be. And if I had done my homework and I could read the room well enough, I could survive. I could add some value. I could be helpful. So I think that was the biggest lesson. And so, I didn't have experience. I didn't have connections. I didn't have anything. And so I think that gave me a lot of confidence over time to be able to walk into rooms that I didn't really have any right to be in. So that was a real lesson for me. I think the other lesson was really just about clients, which was trying to understand. I think one of the things I learned, as a young investment banker, particularly doing mergers, is, a lot of it has to do with the numbers and the dollars and cents, but a lot of it has to do with the ambitions of the CEOs or the board members or whoever is involved in a deal. And if you can understand the people and where they're coming from and what they care about, and what are they trying to build? Are they trying to build a great business? Are they trying to build a legacy? Is it about ego? Then you'd have a lot more sense of how to get a deal done. And again, I was very lucky to work for a lot of very smart and terrific people who I have a lot of respect for, and they pushed me hard.
Sarah, and was there a moment at Goldman Sachs that tested your confidence or resilience where you really had to step up when it was much easier to just step back?
So I grew up in the South. I was from a very polite family. I was not used to getting yelled at or sworn at or anything like that. Like that was not my upbringing. And I think people were, tough. So just one silly example, perhaps, or funny one, but it sticks in my head, which was I was in London. And this, for those, younger listeners, this will sound very funny, but we had basically a mainframe computer that was connected to New York by a cable. Okay. So that was it. And some ship hit the cable or something. Thing went down. So it wouldn't work. So all the computers in London were down. And I remember talking to one of the senior partners on the phone, and here I am saying, well, our computers are down. I can't do this analysis because we don't have a computer. And he just yelled at me and he said, have you got a pencil? Have you got some paper? do it by hand. And he hung up the phone. And I stayed up all night. I did it by hand. I did it with a pencil and paper and a calculator. And that was a good lesson for me because, first of all, I could do it. Secondly, first of all, I got yelled at because I was being, I hadn't come up with a solution myself. I was whining that, the computer was down. I got yelled at, but then I figured out sort of how to get it done. And I think that gave me confidence that, you could kind of figure it out, even if you didn't have the right tool or support or something at the right time.
This story made me think about a funny potential situation that may happen quite soon in the world that we live in, where someone would be told, you need to write a report, and they will say, ChatGPT is down, I cannot write it. And they will say, you know what, we used to write it by hand and we did a pretty good job. I mean, you have a computer, go type it.
Yeah, that's true. I'm sure every generation has the tools that they rely on that the previous generation didn't rely on. So, I would be, hard pressed to fix the engine of a car, but I'm sure, my grandfather could have fixed the engine of a car without, any modern tools. So that's just the way it is. Yeah.
Yes, Department of State, and you have such an incredible career, such an interesting ride we are taking. And I know we cannot give justice to any of those periods of your life, but I'm grateful we have an opportunity to at least touch on it a little bit. So you spent time in public service at the State Department, and that is quite a pivot from banking. Mm-hmm. What drew you to government, and what did it maybe open up in you that the private sector hadn't?
Mm-hmm. Well, as I mentioned, I was young when I graduated from college for a variety of reasons. And so I had been at Goldman Sachs. I thought I would just go to business school and maybe return to investment banking. I didn't know, but I'd gotten into business school, but because I was young, I thought I had time and what people call a gap year now. I thought, it'd be fun to take a gap year. But so I went and talked to John Whitehead, who was at the time the co-chairman of Goldman Sachs. And he was going to Washington to be the Deputy Secretary of State. And so he offered me a position being an assistant to him. And so I decided to do that for a lot of reasons. One, he was a wonderful man and I had a lot of respect for him. And secondly, I do have the sort of the service side is a big part of who I am. And I did learn a huge amount. So, I was sort of a gopher, but my job nominally was to work on business issues for him. So to bring a little bit of a business perspective to what he was doing at the State Department. But we ended up traveling around the world, going to conferences, working on, the issues of the day at that time. And I think that, the first thing I learned is how hard government is. If you're in business, or investing, there's usually a pretty clear bottom line. You're trying to improve your revenues or you're trying to beat a benchmark if you're an investor or whatever it is. There's a pretty clear bottom line. And, in diplomacy in the government, there's not always a clear bottom line. There's not a clear agenda. Different people have different agendas. What they say their agendas are isn't what they really are. And it's much more complicated. So I have a lot of sympathy for people who are trying to get things done in the government. It's very hard. And there's good reasons for that. It's because it's less clear. But I think I learned a lot about global. I learned a lot from John. He was a very a straight shooter. And I was fortunate to have that experience. And I feel very privileged to have represented my country in a small way.
McKinsey. Do you remember what surprised you the most once you joined? Something that you did not expect?
So my McKinsey story is I joined as a summer associate between my 2 years of business school in London. And I had worked in London before for Goldman. And so I had sort of planned to be in London because it was a really, exciting, interesting place. But then when I was graduating from business school, my then fiance, now husband, who is British, was offered a job in Texas. And so I called McKinsey and said, can I go to Dallas instead? Because I had an offer to return. So can I go to Dallas instead of London? And McKinsey was maybe a bit surprised about the request, but was great about saying, yeah, sure. So I had a really interesting sort of contrast of experiences at McKinsey. One was the sort of three big legs. One was in London, where I was just there for a summer, so I wasn't there for too long. Then I was in Texas, and I spent a lot of time working in Mexico. So between Texas and Mexico. And then I was in Boston, where I spent a lot of time working in New York. So my McKinsey experience was probably more varied than perhaps some in a short period of time for those reasons. And I think what I learned there was really how to structure problems, how to try to communicate problems and answers, try to get to the key points, not all the points. To try to be able to speak to a CEO who has a very short attention span, a very short amount of time. And so I even today bring a lot of McKinsey lessons to the work I do.
And speaking of this, what may be one skill or mindset McKinsey taught you that you still use every day or almost every day?
It's to start with the answer. So the McKinsey mindset is sort of what's the governing thought, and then what are the things that support it? There's this phrase that, it's not a mystery story. Don't tell people the facts, and therefore, this, because it doesn't work that way. So, the start with the answer. And I think that's hard, to do, but it's a good way to try to structure, thinking. Start with the answer.
And was there something that McKinsey taught you that turned out to be even more valuable outside of consulting than inside it?
Outside of consulting, I guess what I would say is I worked, again, with a variety of people there. One of the studies that I was put on a pro bono study in Houston for the Houston Fire Department. And that was a very different study than McKinsey would typically do. But it was about, to make a long story short, it was basically there were fewer fires in Houston than there had been in the past because of fire suppression systems. And there were many more needs for ambulances. So there were not enough fire trucks. There were too many fire trucks and not enough ambulances. So the question was sort of, how do you rebalance a system that has gone from firefighting to dealing with all sorts of issues that happen, on the streets and homes in Houston. And so that was to me, a systems change question, which is the world had changed because of technology, because of other, for good and for drugs and other things for bad. And so how do you really shift a system to react to a new environment? And I think that's a lesson that I have taken to other parts of my life as well, which is, when the environment changes, you can kind of wish it would go back to the old way, but that doesn't usually work. You've got to really think about how do you change the whole system because you're dealing with a new reality.
This is such a critical lesson for people to implement. This is so important. Was there someone at McKinsey, maybe a mentor, sponsor, or even a critic that deeply impacted the way you think or lead?
There was. I worked with a person very closely in Boston who I have known now for decades, and somebody who was very smart, very hardworking, and I think really understood the financial world well. Again, which is the world sort of I grew up in of investment banking, investing, but would also question things in a way that just because it's been done that way doesn't mean it's going to be done that way. So I think he's somebody who's been very good at anticipating that things really will change and pushing people to question. So yes, I have a person who came to mind when you said that, when you asked that. Yeah.
And as someone who has since sat on the boards of major companies, how do you now view the role of consultants? Is there something that you wish more consultants understood, and maybe something that you even only understood later on or understood to the degree needed?
Yeah. Well, I think the good news and bad news about consulting is that you typically don't implement things. So usually a consultant comes in to a situation, tries to evaluate the situation, maybe brings tools that somebody doesn't have, a technology consultant or a research methodology, whatever it might be, and then brings that to bear on the problem. And what a good consultant does is they understand, they know what they know, They structure problems well. They listen well. And oftentimes the answer to a problem is sort of sitting in plain sight, but you need somebody to structure it and pull it all together. But what consultants don't do, by the nature of being a consultant, is then take that answer and make it happen. And so I think that the best consultants understand that making it happen is actually quite hard. And I think why a lot of people end up leaving consulting is that they actually want to get their hands dirty and make things happen. So to me, that's always the difference, which is, can you, what I try to do is take the best of consulting, which is being analytical, being able to step back, not being, maybe not being conflicted or not having, wanting one side to, wanting an answer to be true, but being able to ask what answer is right. But then also being able to get it done.
And this is actually one of the common regrets I also hear from senior partners who spend their entire life in consulting. Later looking back, they feel, I really loved my career, but I wish I was on the client side so I could make sure that things get implemented, because a lot of the things we proposed never got implemented.
Yeah. And they probably didn't for very good reasons, or maybe just because, it was hard. It was hard. Yeah.
So you recently wrote the book. What do you want someone who reads that book to truly take away? Some key things you want people to take away after reading the book?
Yeah. Well, I guess the one thing I would say about my experience before I even get into that is then having spent 20 years at Wellington, which is a big investor, and then in my, sort of my hobby of being on investment committees for, colleges, hospitals, that kind of thing. What I've tried to do in this book is take the training of being an investor from multiple angles and translate that, if you will, for business people. So the idea of the book, which is called The CEO's Guide to the Investment Galaxy, is that CEOs sort of go on their journey, and we're kind of riffing off of the Hitchhiker's Guide to the Galaxy, which you may be familiar with that book, where a couple people fly around and land on different planets, and the guide sort of tells them before they get there, are they friend or foe on this planet? What to expect? So this book is meant to be a very straightforward guide to the investment community from somebody who has grown up in the investment community, but who feels strongly, as I do, that the role of the investment community is to fuel business success. It's to fuel innovation. It's to fuel growth, because that is what leads savers to build wealth over time, to retire with dignity, to fund their children's education, whatever it might be that they're looking for on the one side, and for the companies on the other side to innovate, develop new products and services, provide us with, most of the things we all work with every day and use every day that really, make our lives better, from medicines to technology to whatever it may be. So the impetus for the book was, having grown up as an investor, I've spent at FCLT a lot of time with companies and company leaders, and have recognized that there's a real disconnect between the investors and the companies, sort of in the way they look at the world. It may be their language, it may be their training, it may be whatever it may be. But most business leaders have gotten to the CEO office because they're either a great technologist or a great leader of people. Maybe they led a big division. Maybe they led one region of a company and then became the CEO. So they have been very successful at something, or they wouldn't be in the job, but they probably didn't grow up as an investor. And so then all of a sudden somebody says, you have to deal with the investment community. Okay, now you're in this chair, you have to deal with the investment community. And they have, in general, a very sort of quaint, old-fashioned view of the investment community. And that view is that, there are people who analyze their company and think hard about their strategy and want to put money into a company that's going to be successful and all the things that we wish were true, but isn't just not the way markets work today. And so the whole idea of this guide is to say to leaders of businesses, if you're trying to build a company, you probably need capital. You need to understand where that capital is coming from. What are the timeframes and incentives of those people in the investment community? Who are they? What are they up to? Just like the guys flying around to the planets, who are these creatures? And what language are they speaking? And what are they trying to accomplish? So that is the goal in a very straightforward way, because most investors don't explain what they do in a way that makes any sense to company leaders.
And I love that you made it fun.
It's meant to be fun. If you look at the book, you will see pictures, and we've kind of given a moniker to each. So the structure of the book is sort of what are markets like today? Because again, many people sort of have this view of markets, maybe like they were 50 years ago, but not like they are today. Of course, today markets are driven by professionals, not individuals. They are driven by algorithms, not people thinking about sitting there with their pen and paper. And they're driven by incentives that are essentially all either benchmark relative. Investors are competing against a benchmark or their peers. And that's not trying to necessarily get a total return just to, compound money over time. So markets are really different than they used to be, and they're really complicated. So the first part is they're just really different. The second part is, who are all these players? Because once you get into it, there are a lot of people who are called the investment community, but they're really different from each other. An investment banker is totally different than an asset owner, such as a pension plan, who's totally different than a hedge fund or a private equity firm. So what are all these things? And then the last part of the book is meant to be kind of typical journeys of CEOs. So if a CEO is leading a company that's doing well, what can they do? If they're leading a company that has to pivot, what can they do? If they're trying to launch a new company or go into a different market, what do they need to do? So what we're trying to do is say, for a business leader or someone who's aspiring to be a business leader, how do you learn the lessons that a lot of very experienced CEOs sort of learn the hard way? But how do we make that easier with the goal that businesses thrive and they can build great companies and not get off track by some of the incentives of the investment community, which make perfect sense for the investors, but they just don't have much to do with building a great company.
Sarah, and you emphasize that CEOs must build relationships with different types of investors before they need support from those investors. What are some of the best ways a leader can do this effectively?
So I think the first thing is really understanding who their investors are. And even the word investor is sort of a funny word, because does that mean, so we talk about in the book asset owners, who might be the people who ultimately own the company. So that might be a pension plan, a sovereign wealth fund, an endowment and foundation, a retail individual. So who really owns it? Then there are all the people in the middle. So let the asset managers, the people who buy and sell the stock. Then there are the intermediaries, such as the sell side research. Now, if you talk to most CEOs, when you ask them about their investors, they'll actually talk about the sell side research analysts, because they're the ones they spend the most time with. But those are not actually investors in that they don't buy stock. And then the asset managers may buy the stock or sell the stock, vote the shares, but they're not actually their owners, because the owners are ultimately the pension plan or the sovereign wealth fund, whoever that may be. So I think the first thing that a good CEO does is actually understand who owns their shares and who makes the decision. And those are two different things. So that I think that who really owns my company? It sounds like a funny question to ask. Most people should know that. it's actually quite hard to figure out. But it's worth figuring out who the actual owners are. So I think that's the first thing. And then it is, who do I want to own the company? Is it, do they care? Is it fine if there's high turnover, or, quick people who just trade? Or do they want to establish relationships with anchor shareholders, for example, people who might own a big chunk of the company? And different companies will have very different views on that. Depends how dependent they are on capital, all sorts of other things. But really having the way that I think about it is I'm sure almost every company, if not every company, has a customer strategy. If you ask them, what customers do you want? Why do you want those customers? How do you target those customers? Almost any company could give you a very clear answer to that question. If you say, what's your investor strategy? Who are your shareholders? What shareholders do you want? How do you target those shareholders? You often get a very garbled answer, with the exception of some of the best in the business. So that is the problem, that there's a little bit of a view that you just have to take what comes. You can't control it. Money's all the same. Those things don't serve companies well in the long run.
And you already started touching on it, but to give it some extra space because it's an important question, what are the most dangerous misconceptions CEOs have about their investors? And how does that blind spot, so to say, show up in daily leadership decisions?
So I think the most dangerous thing is that companies, CEOs, think that their shareholders are on their team, right? So if you think about a typical company, they work with, and we write about the example of Coke and Pepsi in the book. Coke is a great company, so is Pepsi, but I'm sure the people at Coke, the CEO and the employees and their distributors and everybody, they go to work every day trying to make Coke the best, right? They're trying to make Coke succeed. They're trying to make Coke beat Pepsi. I'm sure it's more complicated than that, but in simplistic terms. The assumption, not necessarily on their part, but on many people's part, is that their shareholders would think the same thing. That if they own shares of Coke, that they would want Coke to beat Pepsi. But that's actually not really true. And so I'll explain why. So a company like Coca-Cola has a lot of retail shareholders because it's a household name. It's an old company. So the retail shareholders probably are on Coca-Cola's team. They probably don't own Pepsi shares. They want Coke to win. But then you've got the hedge funds who don't really think about, as a general rule, don't really think about companies as much as trading patterns, strategies, and so on. So they're usually using, they're not thinking about the company per se, they're thinking about the security. So they don't really care if it's Coke or Pepsi, it's just a security to them. Then you've got the index funds, and they're going to own both Coke and Pepsi forever in regard to the index. So they don't care if Coke wins or Pepsi wins. And then the most challenging part is you have the active managers like Wellington, where they're managing against a benchmark. So if a portfolio manager owns less of Coke shares than are in the benchmark, then they think of themselves as short Coke, if that makes sense. So they're a shareholder, but they actually don't want Coke to succeed. And so when you add all of this up, not quite half of Coke's shareholders actually want Coke to beat Pepsi. Now that kind of thing blows most CEOs' minds, because the challenge is their assumption that they usually make is their shareholders are on their side. They own the shares. They're their owners. But that's not what they want them to succeed over long periods of time. And that's true for some, but that's not true for a lot. And I think that's the source of the disconnect, because then if a shareholder says to a company, we think you should do this, that, or the other thing, they assume they're on the same team. They assume they're supporting them. They assume they want them to succeed. But if that's not true, or if their definition of success is just simply different, then that's where the misconceptions come in and the friction comes in. And the often timeframes are part of that, which is, somebody's got a different time frame than somebody else. So again, the investors' incentives aren't wrong. They're not bad. The company's incentives are not wrong. They're not bad. They're just different from each other. And that's where you often see the disconnect.
And in your view, how has the CEO role fundamentally changed over the last, let's say, 20 years because of what is going on in terms of shifts in the investment landscape?
Yeah. So I think 20 years ago or longer than that, it perhaps people didn't have to worry too much about activists. I think many CEOs had their board were sort of friends. They were sort of, or at least friendlies. And they didn't get the kind of public scrutiny that they do now. So the job of a CEO today is very hard because they cannot say in this world of social media, they can't give one message to one group and a different message to a different group, which I think you could in the past. You could tell your employees something, you could tell your customers something, you could tell your shareholders something, and each would listen to their own message. That doesn't work anymore. And so the challenge that CEOs have is they have people who want really different things. They have, whether that's employees or customers or shareholders or other sorts of stakeholders in their community, governments, and they have to try to communicate with all of them in a way that resonates with the others. And that's very, very hard. So I think that's the biggest difference is, I think 20 or 30 years ago, a CEO would kind of be able to talk to different constituents in a different way. And now it's very hard.
What are the signals that a CEO is sending, perhaps without intending to, that attract the wrong kind of capital?
So one thing that is controversial, but I believe, is that CEOs probably spend too much time on quarterly calls and talking to whoever dials in. So who dials in on a quarterly call? It's not typically shareholders. It's typically the sell side analysts. Those are the people who ask the questions. And just to explain why, the sell side analysts, they tend to ask questions. They tend to publish their reports. That's what they want to do. So they're more like a journalist, a financial journalist or journalist with a spreadsheet. In our book, we call them weather forecasters because what they do is they take in all the information that they can and they make a prediction about what's to come, next quarter's earnings, next year, whatever it might be. And usually they're quite good at, just like weather forecasters are usually pretty good. Sometimes they're really wrong, but usually they're good. So they spend a lot of time talking to those people. And then that's not a problem if they're just speaking to them, but then they listen to those short-term questions and the short-term people. And when they listen to the question, how many widgets did you produce this quarter? Why is this going? Then that's when sometimes it gets into their head that they should be doing something short term to improve their stock price in the short term. And the kind of things that we're talking about, the classic examples would be cutting R&D spending or cutting marketing spending because you realize you're going to miss your earnings for next quarter. In the short run, that gets you there. In the long run, it degrades the business as a whole. So I think what the best CEOs do is they let their CFO or their investor relations person or somebody else really handle most of those the more short-term questions, the more short-term oriented people. And they then think about who their long-term shareholders are that they really want to spend their time on and spend their time there. So of course you have to disclose things to everybody at the same time in terms of facts and so on. But companies still talk to their investors, and that's a good thing. So spending where a CEO spends her or his time, I think, is what's critical.
And the last question I wanted to ask for today is, how should the CEO think about communicating risk and long-term bets to an audience conditioned for short-term performance? Let's say if they have to talk to.
Yes. Yeah. So the best practice is to lay out a roadmap, a long-term roadmap of where you expect to be going. And so short-term is not bad, but it needs to be a milestone on a longer-term path. And so let's just say a company needs to make big investments because the technology is changing or because they're entering a new country or whatever it might be. If they have a long-term roadmap that lays that out and where they're going to go, the investors take comfort in that. The longer-term ones do. Now, inevitably, something will change. The market will change. There'll be a geopolitical event, whatever it is. But then the CEO can say to the investor, well, I was going to do this, but now, of course, as you see, things have changed. And so we're going to shift in this way. And investors are very good at changing their mind. Look at what stock prices do every day. Like investors are, CEOs are often loath to say they changed their mind. Investors change their mind all the time because interest rates change, policies change, whatever it might be. So having a long-term plan and being willing to say, well, we're shifting that plan for these reasons, I think is the fundamental way to having stronger and better and longer term engagement and getting out of the quarterly cycle. And then, of course, definitely not issuing quarterly guidance. A minority of firms issue quarterly guidance now. It's less than a quarter, and it's a detrimental practice.
Sarah, thank you so much for being here. Such an incredibly interesting discussion. Where can our listeners learn more about you, buy your book, anything you want to share?
Yeah, so the book is The CEO's Guide to the Investment Galaxy is available for pre-order on Amazon or on Wiley, who is the publisher's site. So typical places. And then to learn more about FCLT Global and our work in terms of focusing capital on the long term, our website is FCLTglobal.org. And we have a lot of research that we're pleased to share there. So either of those places would be a great place to go.
Our guest today has been Sarah Keohane Williamson, author of The CEO's Guide to the Investment Galaxy. And this episode is brought to you by strategytraining.com. If you want to strengthen your strategy skills, you can get free resources from Firms Consulting. You can get the overall approach used in well-managed strategy studies at firmsconsulting.com/overall approach. You can also get McKinsey and BCG winning resume example, which is a resume that got offers from both of those firms. And you can get it at firmsconsulting.com/resume PDF. And you can also get one of our books. It's called 9 Leaders in Action. We actually co-written it with some of our amazing listeners and clients. And you can get it at firmsconsulting.com/gift. Thank you so much for tuning in. And I'm looking forward to connect with you all next time.